is not resting on his laurels. As head equities at DSP BlackRock Investment Managers, Anup and his team strive each day to ferret out stocks that may lead the next bull run. With more than 15 years of experience in the mutual fund business, Anup has built his expertise in managing offshore schemes. In fact, in his current role, Anup oversees 13,000 crore rupees via domestic funds and nearly 8,000 crore rupees worth of funds based outside India. An IIM Lucknow graduate, Anup believes that a revival in corporate earnings is the key that predicts an upturn in markets. Hence, identifying growth companies is critical. As someone who enjoys flying, Anup understands the value of patience in a tough market. But has that wait ended?
Unfortunately, I think there's still some time to go. I think clearly it's going to take time for the situation to repair itself. Now, what we've noticed about markets is markets don't stand still. They have a habit of moving up and down irrespective, and short-term sentiment will influence the market. So we're not saying it doesn't have any short-term upside or downside or whatever. But our sense is it just trades in it sort of spends a lot of time in a range for a while until the valuations sort of sort themselves out and the situation potentially starts improving. So what we've seen is markets don't bottom out when you can see the obvious positives coming through. So we are fully aware of the fact that there will be a time to invest, notwithstanding the bad news, from where markets will move up substantially potentially, but it has to be at the right valuation. And our sense was that at this point in time, the valuations are not appealing enough to sustain a structural move in the markets. So we are very positive long term. I don't think you'll catch any fund manager being negative long term. Yeah. And we are positive as well. It's a great, growth potential. But, you still have to be fairly patient. I think this is not the phase where you should just walk into equities expecting a consistent return coming through. We still think over a 5-year block there should be some decent return coming through. But, it may test you.
The last 5 years have not been rewarded.
It hasn't been the case. Yeah. And, there's no rule of law that suggests it has to happen every 5 years either. But all we know is as long as eventually corporate earnings grow, that's the real question. Will corporate earnings stay static for another 5 years as they have for the last 3 or 4 years? If you're convinced that that's not going to happen, then it's logical that equity markets will also follow corporate earnings.
What do you make of the intermediate rallies that the market gives then? You really work with a 6-month timeline. Now there is expectation building that maybe by the end of the year, early 2013, things will start changing.
We're always very hopeful, right? So it always looks like 6 months later things will get better. That's a very typical psychological thing. So that's normally the way you start off the year, thinking at least the second half may be better than the first half. Yeah. But at the end of the day, I keep coming back to the fact that we need corporate earnings to sustain any market movement. So markets will move in the short run. You will always have, as I said, they don't stand really static. But the sustainability of the move is what we're more interested in. You could have the markets go up 10%, but if they're finally coming down 10%, we could explain it all the way up and then have to explain it all the way down, and reasons will be found. But it doesn't really help anyone's cause eventually. So what we're more interested in is the markets that move up and, deliver consistent returns over a period of time to investors.
You have said that the rupee's fall has in a way absorbed or reflected all the bad news that's been there in the economy. Do you think that there is more downside to the currency?
Sure. So, calling the currency is probably worse than calling equity markets. Very rarely have we found anyone getting the currency view right. In fact, I remember somebody mentioning that, calling the currency is like, shooting yourself in the foot while it's still in your mouth. So, it's very difficult to gauge. But I think what I meant at that point was the fact that the currency has given way is the first step towards repairing India's balance sheet as a whole. I think it helps a lot from a current account deficit point of view. It helps significantly now that oil has started retreating as well. So I think, we're getting ingredients of macro improvement slowly. I don't think we should expect to see the result of these very quickly. But the government in the last few days has started to make the right noises, even some of the right actions. If we had to give them the benefit of doubt, the fact that the currency has already depreciated, all of these, when you put it together, it's definitely potentially a better macro outcome than it was maybe 6 months ago, where things were just heading downhill. So you seem to have managed to reach a point where there is a bit of repair that has begun. We're going to see the benefits of that with a lag. So I think the near-term GDP numbers will still not look good.
Is it fair to say that the downside of the market has been determined, but how much upside there is right now can't be said with a fair amount of certainty?
It's tough to stick your neck out and say that the downside is defined because, events keep progressing. But, I think it's fair to say that the market it doesn't seem like it's in the mood to collapse. And it's sort of correcting more through time rather than through very extreme movements, which is a good sign actually. So people do see value at the end of the day in sort of equities, but you're not just seeing the return coming through in the near term. The other thing, of course, I must mention is when we're just talking in very general market terms. But the fact of the matter is there's a lot within the market that you have to really focus on, and there are parts of the market that always perform or underperform. So that's the beauty of the Indian market, at least, that we've experienced for many years now, which is, valuations are at extremes across sectors. You can, pick and choose correctly. So there are value opportunities even though the broader index may not fully reflect that.
Now the government, of course, has made it very clear that they are going to be pushing investments in the infrastructure space.
Well, it helps the sector for sure. I think if the government starts addressing sector by sector, so power clearly is the biggest challenge. It's the largest sector from an infrastructure point of view or a capital expenditure point of view. So if the government does manage to sort that out or come out with clearer policies to enable further investments, then clearly there is some value in that sector. So, we've got to look at opportunities there. Again, it's a bit like the overall market view in the sense that it's going to test patience. I don't think you're going to see immediate results. A lot of these balance sheets are fairly damaged. Equity values are very low, but they have a lot of debt.
And the concern with infrastructure companies is that there aren't many with high IRRs or internal rate of returns.
Yeah, there's very little to show in terms of returns on capital employed. So they've put a huge block of capital without any returns because those assets aren't generating anything or very little. And you've also got very large amounts of debt in your books. So it's a very awkward balance sheet to invest into as a shareholder. And you could make quite a few mistakes also if you just took that very broad call that let's buy the whole sector. So you've got to be very careful. There's no doubt about it. But there are, individual pieces of value.
All right. How do you tie in your individual fund philosophy or investment philosophy to the philosophy at the broader level for the fund house?
If you looked at the broad Indian market as a whole, one of the reasons why we still think it's a patience game is that if you look at the spread, this gap between the return on equity of corporate India and interest rates in corporate India, that spread has actually been declining for the last 4 years. So typically when it's lower, your valuations are lower, and as that spread starts expanding, your valuations pick up. Now, why are we optimistic about the next 3 or 4 or 5 years? Because we see a phase at some stage where as corporate earnings start picking up, the return on equity or return on capital ratios move up. As your profits start rising, then the returns on your capital will start rising. So that will help. And if interest rates fall, that gap starts increasing, and that typically marks a re-rating of the market as a whole. So we're waiting for that period where this gap starts opening up and not contracting.
Time-wise, do you think that can happen by the end of 2012?
No, we'd have to be really optimistic for that to happen. I'd love for it to happen, but practically I can't see that happening right away. But it does look like, as I said, the ingredients are being put in place. So it clearly gives us some reason to be optimistic.
All right, Anup, we'll talk about that and more in just a bit. After the short break, we will discuss with Anup his specific fund philosophy. Stay tuned for that.
स्टाइल मारा तो डरना क्या थोड़ा हीरो बना तो डरना क्या ओ ग्लैमर ही है कोई चोरी नहीं है जरा फिल्मी बना तो डरना क्या
hearts. That's the mark of a champion.
Thank you.
Welcome. Indian Overseas Bank. Touching hearts. Spreading smiles.
Welcome back. You're watching Meet Your Fund Manager right here on ET9. We're still in conversation with Anup Maheshwari of DSP BlackRock. Anup, let's discuss some of your funds, starting off with BlackRock Top 100, which is a large cap fund. Now, it's an actively managed portfolio. My question to you is, is that a conscious strategy? Do you think that a strategy of buy and hold is difficult in this kind of a market environment, so you need to kind of churn the portfolio?
Well, to some extent, yes. So that's been the case for quite a few years now, actually, given the changes in the market that we've experienced. We've said right from the start when we launched this fund that this would be a very actively managed product. It focuses only on the top 100 companies by market cap. So within that, if you have to construct a 40 stock portfolio, you typically have to move a little bit around, across sectors, across companies, depending on where you are in that cycle and where valuations stand. So it's clearly an actively managed portfolio, and you'll see that clearly from the fact sheet as well, that, we do take active market views as well as stock views.
What I've also seen in the risk profile of this fund that your beta is less than 1, whereas you have an alpha of 5.3, which is without increasing the risk of the fund, you've been able to generate returns. And that too in a portfolio where FMCG and healthcare, the traditional defensives, are not the top 2-3 sectors. They're lower on the pecking order. How have you managed to do that?
Well, that has come largely through, some degree of active stock selection. So we've had some companies which, let's say in the auto space, that we had made a fairly large part of the portfolio, which did pretty well over the last 6 months and therefore have ended up outperforming some other names. So that really becomes a little more bottom up. As I said, we've also taken a few active positions from time to time. We manage cash quite actively, up to about 7% of the portfolio. So I think it's a combination of these factors really, where you may, not see the same sector weight, but within the sector, if you have the right sort of stocks, you can still, outperform potentially.
You spoke about the cash calls that you take on this fund. Is there an option between increasing cash to taking a position on the future side? When is it that you prefer holding a future versus holding the stock?
Sometimes in transition, when we're changing the characteristics of the portfolio, let's say you're deciding to overweight or underweight a certain sector. It's also sometimes where you're not necessarily seeing anything specific in terms of value in the market, and you just want to stay broadly exposed to the market without any specific stock being added at that particular point. Maybe you want to buy a certain stock slightly lower than it is priced on that day.
Okay, I also see a big underweight on financials and energy as part of this portfolio. Why is that?
Well, financials is, again, it's the selection here. So we've been underweight the public sector banks in particular, relative to the private sector banks. So we have a exposure to the private sector banks, which is reasonably good. But when you aggregate it together, it looks like we're underweight the index. The index, in any case, has a very large weightage in financials, close to 26%. So we've run a underweight on financials across most of our portfolios, but we haven't done very badly, irrespective, even though financials have performed, because the private sector part of the portfolio has done reasonably well. On the energy side, again, the largest component of energy, a very large cap company, is not a large weight in our portfolio. In fact, we've gone there quite the opposite way versus the banking sector. So there we own more of the oil refining and marketing sector. So there's one specific name that we've had there, which has actually done very well for us. So that's an example of where you maybe underweight a sector, but because of your stock selection, for example, since you've got the portfolio, owning a BPCL versus something else has actually helped the fund outperform the sector.
Do you think there's value emerging in public sector banks right now? The broad call has been with private banks. Do you think that could be changing?
Public sector banks have value, generally speaking. There's no question about it. They're cheap. They're not expensive by any stretch of imagination on all valuation parameters. I think the only issue there is clearly over the next few quarters, we're still going through a phase where the economy is facing stress. Companies are restructuring their loans as much as they can, and therefore banks are continuing to face that uncertainty in front of them. So from our point of view, we like public sector banks, but it's more of a timing thing.